In this presentation, I discuss financial leverage and financial risk. I'm Pat Obi, Professor of Finance, Purdue University, Calumet. We've already learned that financial leverage involves the use of debt, leases, and any other fixed cost means of financing a firm's operations. Also, we've learned that the use of financial leverage, while it provides the firm with tax savings benefits, introduces additional risk to the stockholders, and that risk is called financial risk, which essentially is the risk of bankruptcy because the firm is overly leveraged. And this risk is in addition to the business risk exposure of a firm, as we have already discussed. Now, in particular, all things equal, rising financial risk, as I note here, causes the firm's cost of debt and therefore the firm's weighted average cost of capital to rise. And this might adversely affect the value of the firm. Now, one way to capture the adverse effect of financial risk is to calculate the degree of financial leverage, which, as I show here, is the percentage change in the firm's net income due to a change in the firm's operating income measured by the firm's earnings before interest and taxes. And so the performance measure here is net income. We want to find out how the firm's net income would be affected if the firm's operating income were to change by a certain small amount. And some refer to this as second leverage, because if I go forward, I show here that it takes off from where degree of operating leverage ends. If you recall, the degree of operating leverage is going to be looking at how the firm's EBIT would change for a given change in sales. This time around, degree of financial leverage is going to be looking at how the firm's net income will change for a given change in EBIT. So now, real quickly here, suppose you calculate the degree of financial leverage, which, by the way, you can see the calculation formula right here. It is sales minus variable costs minus fixed costs, and this numerator here is going to be your earnings before interest and taxes, EBIT, and you divide that by sales minus your total variable cost minus your fixed cost minus your interest charges. So that essentially would be your earnings before taxes. So this ratio calculates your degree of financial leverage, which is interpreted in this manner. It's going to tell you again by how much your net income will change for a given change in your earnings before interest and taxes. So as I started to say, suppose your DFL is equal to 2. What does that mean? Well, this is going to tell you that if your operating income, your EBIT, were to fall by, for example, 10%, it tells you here that your net income or any of the other bottom performance measures like earnings before tax, earnings per share, that they would fall twice as much. So this 2 here is a measure of elasticity. It's a type of derivative, if you like. So it's going to tell you the degree of impact. So for any change in EBIT, net income is going to change twice as much, telling you therefore that the larger this number is, the greater would be the adverse impact that a given decline in EBIT would have on the firm's net income. Because if this DFL, for example, were to be 5, then if EBIT were to drop by 10%, then it tells you that net income would drop 5 times as much, which means it'll drop by 50%. In this example where DFL is 2, it's telling you that your net income would drop twice as much, or by 20%, which is 2 times 10. So in this working example, which is the same as what I used earlier for degree of operating leverage, here when we calculate the degree of financial leverage, it comes out to be 1.1628, which tells you that if your EBIT were to decline by a certain amount, that your net income would decline 1.16 times as much. So here where we assumed this decline in sales, which brings about this 14% decline in EBIT. As you can see here, from 250,000 to 215,000 is a 14% decline, as I note right up here. So without further calculations, we know right away that a 14% decline in EBIT will bring about a 1.1628 times decline in net income, meaning multiply this 1.1628 by 410, and that's going to come out to be 16.28%, as I demonstrate here. That tells you right away that that's how much your net income is going to decline. So without even performing the rest of these analysis, if you were to tell me that going forward we're expecting a 14% decline in EBIT, do I know by how much net income will go down? I'll tell you right away that it's going to be 16.28%. And you're going to say, well, how did you figure that out? And I'll say, well, it's the degree of financial leverage multiplied by the percentage change in EBIT. And of course, you can verify that by continuing the calculations right here, and you'll come up with a net income of 108,000, and you can see for yourself that the change from 129,000 to 108,000 is indeed a 16.28% decline. It works the other way around though if EBIT were to go up. So you will see that a higher degree of financial leverage would mean that your net income would go up a lot more. But that, of course, is not the concern here. The concern here is the risk factor. What's going to happen if things were to go bad? And that concludes this presentation on the degree of financial leverage.